1 into 20, 20. Okay, it's 26 marks. Okay, you can expect that way. That is the maximum you can expect. Anyway, I'm telling we are following Kaplan textbook only, right? In
Yes, sir.
Kaplan textbook, how many chapters are there in business finance? As per Kaplan textbook, how many chapters are there from business finance?
5.
Yeah, there are 5 chapters. Excellent, Sheikh. There are 5 chapters. Okay, it's actually chapter number 15, 16, 17, 18, and 19. Okay, anyway, there are 5 chapters. I'm not telling this in the order, but according to the priority, I'm telling. Could you please tell me which is the most important chapter among the 5?
Business valuation, sources of
No,
finance.
business
Cost of
finance.
capital.
Cost of capital. Excellent, Sheikh. Cost of capital is the most important chapter in business finance. So there are certain chapters in business finance, and cost of capital is the most important one. Then could you please tell me which is the second most important chapter in business finance?
Capital structure.
Sources of finance.
Yeah,
Source of finance.
source of finance actually. Next one I would say source of finance. Sources of finance. Source of finance is the second most important chapter. Then the third most important chapter.
Capital structure.
Capital structure theories. Yeah, capital structure theories. Capital structure. Okay, capital structure theories. Then
Dividend policy.
Dividend policy. Dividend policy is maybe if you ask me which is the smallest chapter in financial management, I can tell you dividend policy is the smallest chapter. You can study dividend policy with it half an hour. Half an hour, you can study the entire dividend policy. You can set a timer. Okay, how if you think yourself, how can I study dividend policy? Set a timer for 30 minutes, and within that 30 minutes, you can easily cover the entire dividend policy. Okay, that much small chapter it is. That much small chapter dividend policies. And we do have one more chapter, which
Business
is
value.
no, not business valuation. Business valuation is an entirely different topic. Okay, it's an entirely different perspective. Here we are looking at whether we should raise the finance by equity. What will happen if our debt is increased? Everything. It's about finance. Valuation is different. Valuation, they are valuing a company. Here we are thinking about how to finance a company. Okay, equity, debt, preference shares, whatever the thing is. Okay. Anyway, dividend policy, and the final one. One more chapter is there. Which one?
Financial ratios.
Financial ratios. Okay. There is one more chapter called financial ratios. Ratios are important for all the papers, except I think tax. For tax paper, ratios is not that much important. But except tax, TX, all other papers in the skill level like FM, PM, FR, AA. Okay, all the 4 papers you must have proper knowledge about financial ratios. There are some ratios you must study. You must understand what is the concept behind that ratio. Okay, never try to by heart the equation. You have to understand why. Always ask yourself for any paper you study. It's not the question what. Always ask yourself why. Why this ratio is this like? What makes this ratio meaningful? Okay. Always ask the question why. Okay, that's how you learn. Anyway, we do have 5 chapters, and we do have 20 to 26 marks. And from the whole 5 chapters, you can expect only 3 types of question. I can assure you that from the whole 5 chapters, only 3 types of question can be tested. I can assure you. Only 3 types of question can be tested. Anyway, I'm gonna give you all the 3 types of question. Before that, let me tell you what are the things that you learn in cost of capital. What are the things that you learn in cost of capital? Kindly
Cost of equity.
Yeah, you
Cost
must
of
learn
debt.
cost of equity, KE, I would say. Then
Cost of debt.
Cost of preference.
cost of preference shares, yes, KP, I would say.
Cost of debt.
Cost of debt.
Cost
KD.
of debt, KD. Okay, KD can be 2. KD of loan note and KD of
Convertible.
what? Yeah, KD of loan note and KD of bank loan also.
Bank loan.
Bank loan. You must be able to study both KDs. KP is quite easy. KE is somewhat difficult. Not that much difficult. I will explain you. Anyway, no problem. So anyway, after calculating all these, with all these, you can calculate the whole thing called
WACC.
WACC. Okay, WACC you can calculate. WACC, weighted average cost of capital, right? WACC you must be able to calculate. Okay, so that is what you learn basically from cost of capital. You must be able to find WACC using KE, KP, and KD and all. And within that, you must be able to learn the CAPM model. CAPM model. It's an important theory question about CAPM model. Then I can also tell you that CAPM model. Then
Degearing and
degearing and regearing method. Yeah, degearing, regearing method. Degearing and regearing method. Okay, degearing, regearing. Or else I would say more than that. I would say project specific KE. This would be a better idea about the topic. Degearing, regearing is the method, but we are calculating the project specific KE here. And one more theory, systematic risk and unsystematic risk. Could you please tell me what is the difference between systematic risk and unsystematic risk?
Systematic risk affects only a specific industry, but it's unsystematic. It affects every business.
No, you're wrong. Actually, you told just the opposite one. Systematic risk will affect what?
Entire stock market.
Entire stock market.
Yes.
Okay, the entire system will be affected, but unsystematic risk will affect only
Specific sectors.
Specific sector or specific industry, right? Any specific sector or any specific industry, unsystematic risk. So there is a method called diversification, which means we can invest in different companies. Okay, on which method, on which risk, like systematic or unsystematic, in which risk we can eliminate or reduce risk by diversification?
Unsystematic.
Unsystematic, because in unsystematic risk, it is affecting only a specific company or a specific sector. So by diversification, like investing in different sectors, we can reduce that risk, right? So only in unsystematic risk, you can reduce that risk by diversification. Diversification means we are we are keeping a diversified portfolio, which means we are investing in different types of companies, different sectors. Okay, then you must also be able to understand between risk versus return relationship. So what is a risk versus return relationship?
If risk increases, return also increases.
Okay, if risk increases, return also increases. Let me ask you, KI will be there, KP will be there, KD will be there. Whatever question you may come across, which one will have the higher value?
KE.
KI. Why KI?
Equity shares. Equity have more risk.
Yeah, KI will have more risk because ordinary shareholders are taking more risk than preference shareholders, and then more risk than debt holders, right? So KI will be having the highest risk. Cost of equity. Equity shareholders will be facing highest risk. So let me ask you, why did they face higher risk compared to others? Why do they face higher risk? Because
the returns.
Yeah, no,
returns are not fixed.
Their returns are not fixed. Okay, it's up to the company whether to decide whether we have to give dividend or not. Dividend is what the equity shareholders will get as a returns, right? But the company can decide whether to give dividend or not. So their what returns is not fixed, and then they will be settled in the last only. They will be settling the last after settling what preference shareholders and after settling debt holders only. Okay, means equity shareholders will be settled, and their preference, as you told, their dividend is not fixed. The company can decide, right? Preference shareholders will get dividend for sure, but equity shareholders dividend is not sure, right? Okay, since then they are facing more risk, so that they should be given more returns, isn't it?
Yes.
Okay, so that is what risk versus return relationship. Then let me
But
ask
a small doubt, in practical, they will get like that, sir, if you are taking more risk, more return, because if company has no value at end, so they will not get no, sir, return.
In practically, there is also some more things that need to be considered, but theoretically this is the answer. But in practical life, anything can happen. Okay, anything can happen in stock market. Anything can happen, as you will study it later. Okay, this is only, all the things are only theories. Practically there will be difference. Okay, so we'll discuss everything. Anyway, in sources of finance, we'll be discussing about what are the different sources of finance available to a company. So here you have to learn about debts,
Equity finance.
equity finance. You have to learn about equity finance, and you have to learn about the methods of raising equity finance. Could you please tell me what are the methods of raising equity finance? Please tell me any methods of raising.
Rights issue,
Right
placing,
issue.
Bonus
Sorry?
issues.
Owners.
Placing.
Right issue is there. Then
placing,
placing. Yeah, private placing will be there. Like we can privately give
Share
to a
exchange.
not share exchange.
Stock market, sir.
Public offer.
Public offer. In stock market, we can
Crowdfunder.
no, crowdfunding is not an equity fund raising method. Actually, it's crowdfunding is actually kind of a debtor. Okay, and anyway, we learned about, I can tell you, public offer will be there. Publicly we are issuing large number of shares through stock market. It's called public offer. Initial public offer will be there, because before entering into the stock market, a company can issue their shares before entering to the stock market. Are you familiar with Chennai Super Kings?
Yes.
yes,
It's an IPL team, right? Chennai
Yes.
Super Kings do had their IPO in 2000. Are facing more risk, so that they should be given more returns, isn't it?
Yes.
Okay, so that is what risk versus return relationship. Then let me
But
ask.
a small doubt, in practical, they will get like that, sir, if you are taking more risk, more return, because if company has no value at end, so they will not get no, sir, return.
In practically, there is also some more things that need to be considered, but theoretically this is the answer. But in practical life, anything can happen. Okay, anything can happen in stock market. Anything can happen, as you will study it later. Okay, this is only, all the things are only theories. Practically there will be difference. Okay, so we'll discuss everything. Anyway, in sources of finance, we'll be discussing about what are the different sources of finance available to a company. So here you have to learn about debts.
Equity finance.
equity finance. You have to learn about equity finance, and you have to learn about the methods of raising equity finance. Could you please tell me what are the methods of raising equity finance? Please tell me any methods of raising
Rights issue,
right
placing,
issue.
Bonus
Sorry?
issues.
Honors.
Placing.
Bonus.
Right issue is there. Then
placing,
placing. Yeah, private placing will be there. Like we can privately give
Share
to a
exchange.
not share
Yes.
exchange.
Stock market, sir.
Public offer.
Public offer in stock market we can.
Crowdfunder.
No, crowdfunding is not an equity fund raising method actually. It's crowdfunding is actually kind of a debtor. Okay. Anyway, we learned about, I can tell you, public offer will be there. Publicly, we are issuing large number of shares through stock market. It's called public offer. Initial public offer will be there because before entering into the stock market, a company can issue their shares before entering to the stock market. Are you familiar with Chennai Super Kings?
Yes.
Yes,
yes,
it's an IPL team, right? Chennai
Yes.
Super Kings do had their IPO in 2000. I don't remember the year. They gave their IPO, initial public offer. Before entering the stock market, a company can give their shares, which is called initial public offer. Chennai Super Kings have given their shares. I think one more team from IPL have given their shares. I think maybe RCB. I don't remember. Chennai Super Kings have given. Manchester United. Are you familiar with Manchester United?
yes,
In 2012, again, I think Manchester United also have issued their IPOs. Are you familiar with Lulu company from Kerala?
Yes,
In
sir.
Kerala, it's famous in in Hyderabad there is a Lulu mall. In I think Telangana there is a Lulu mall, right?
yes,
A big mall. Yeah. In Kerala also there are Lulu malls, and in it's mainly in Gulf countries. Anyway, Lulu company also have issued their IPOs. IPO means before entering stock market they will issue their shares. That is what IPO. So one among the method is public offer, and second one initial public offer. Then next one, right issue. We can right issue our shares, right? We can right issue. Right issue means we are giving our shares to the existing shareholders for a discounted price. Okay, if $5 is the current share price, and we may give a discount, which means around $1, for example, and we will give the shares for $4 to our existing shares. So in right issue, what is the biggest advantage we get?
Our equity will not be to external.
Yeah, I can. There is a word actually. Dilution of control won't be there. Dilution of control means spreading the control to more people. Okay, dilution of control won't be there. That is the biggest advantage of right issue, right? Okay, so we discussed about public offer, initial public offer, right issue, and there is one more thing, placing, private placing. We are giving our shares to someone or for a person or an institution through an intermediately directly. Okay, not to the large public, but to a company, to an institution, or to an individual directly. We are placing. That is what private placing. Okay, private placing, not through stock market. Privately, if we are giving shares to a company through an intermediately like a bank or any financial institution, it is called private placing. So 4 methods are the mainly. We have to study at least that 4 methods. Okay, and we have to learn what are the advantages and disadvantages of all the methods. At least you must be able to write up to around 3 marks for each method. Okay, so that is
What
what
will be the disadvantage, sir, of rights issue disadvantage?
right issue, as I told, dilution of for right issue, dilution of control won't be there. But the problem for right issue is that maybe our existing shareholders, if they don't have enough cash, they will sell to the public. We might have to sell to outsiders, right? Our existing shareholders should have the cash in order to buy it for discounted price, right? If they don't have
Yes.
enough cash, we may have to sell it to the outsiders. That will affect our dilution of control, right? Okay, and
Yes, sir. Before
yeah.
all this method, retained earnings will be there, sir. We have to first do from retained earnings.
Yeah, we can take from retained earnings, but it's not a fundraising method. Retained earnings is actually in our own fund, but it's actually not a fundraising method, right? I'm asking about how to raise equity finance. Retained earnings is already raised fund. We have keeping. So let me ask you one question first of all. What do you mean by retained earnings actually?
That profit kept aside for future.
Profit kept aside. So what do you mean by reserves?
Sir,
What's the
that's also
the cash after dividend.
What's the difference between retained earnings and reserves? Anyone? It's an open
sir,
question. Both are actually part of profit actually. Profit kept aside.
reserves
Retained
are for long term.
No, I want much more specific answer. It's a basic question, basic accounting thing only. I'm not that much brilliant in accounts. Anyway, I can ask some simple question and make you confused. Okay, what is the difference between reserves and retained earnings? I can tell you. The difference between reserves and retained earnings is that both are what profit kept aside, but reserves are profit which kept aside for a specific thing. Okay, maybe to give salary or maybe for something. For a specific thing, if you are keeping the profit aside, then it is called reserves. If you are keeping the profit aside, generally it is called retained earnings, right? If it is for a specific thing, then it is called reserves. Anyway.
Future uncertainty, so retained earnings will be there.
Future uncertainty, I didn't get the question.
For future, anything happened, loss to
Yeah, reserves is kept for a specific thing. Retained earnings, we are not keeping for a specific thing. Okay, not specific thing. If anything happens or we can take from retained earnings. Reserves are kept for a specific, maybe to give salary, maybe to give any liabilities there. We can take the amount from reserves. Okay, in bike there was reserves, right?
Yes.
Okay, reserve, we do have reserve petrol. So it's kept for any any dangerous situation comes in, reserves you can take. Okay, we are keeping reserves for something specific. Retained earnings is something general. Anyway, so okay, let me ask you one more question. Can bonus issue be used for raising equity finance? Yes or no?
No,
Why?
It doesn't bring any
Because-
cash into the business.
it doesn't
Yeah.
raise any capital.
Yeah, it doesn't bring cash. Bonus issue is what? Right issue is giving the shares for a discounted price to the existing shareholders. What do you mean
Yes.
by bonus issue?
Instead of dividend, we can give bonus issues.
Yeah, Yusuf, what you said was right, but I'm asking, what do you mean by bonus issue? Instead of dividend, we can give a bonus issue. But what do you mean by bonus issue? You are right, actually, but I'm asking, what do you mean by bonus issue? What is that?
Company issues free shares
A company issues free shares
to
to
existing shares.
existing shareholders. Now you're right. If the company is giving new shares for free to the existing shareholders, if you are giving the shares for free, will we get any amount cash? Our company? No, right? We don't get any cash. We don't receive cash because it's so it is not a method of raising equity finance. Okay, so never write bonus issue as a method of raising equity finance. So we are not getting cash, but our number of shares will be increased, right? Number of shares will increase, but we don't receive cash. Our equity capital won't increase. Our equity capital won't increase. Anyway, after learning all these, you must be able to learn about TERP, theoretical X right price. Did you know how to calculate TERP?
Yes.
TERP is one of the important topic. You must be able to understand how to calculate TERP. And also you have to learn about TSR, total shareholders return. Total shareholders return. So TSR is also an important topic. So please take the notes. I'll come within few seconds. My battery is low, so I have to charge this one. Okay, please take the notes. I'll be back within few seconds. Okay. Many people are leaving, so please don't go. You will feel this session really helpful. So TSR means total shareholders return. So what are the returns that a shareholder can expect from a company?
Dividends,
Dividend,
capital gains.
Yeah, dividend and capital gain. Their share value will increase and also they will get dividend. So there is actually one equation to calculate TSR, total shareholders return. So please do learn the equation of TSR and TERP. Both TERP and TSR is highly probable in session A. In session A, that you can expect a question of TERP and TSR. While learning TERP, you must also be able to understand what do you mean by value of right. You must be able to understand what do you mean by value of right and value of right per existing share. Both you have to learn. Both are really, really important. Okay, anyway, TERP and TSR. Then the next thing you have to learn is about SMEs. What do you mean by the term SMEs?
Small and medium enterprises.
Small and medium enterprises. So you must be able to understand what are the problems SMEs are facing. SMEs are facing a lot of problems. So you must be able to understand their problems and what are the solutions they have. Here, you must be able to learn crowdfunding, peer-to-peer funding, everything. Okay, those are the solutions and the problems also you must learn. Anyway, SMEs are there. So then venture
TERP,
capital.
meaning of TERP is nothing but value of share price after the issue of rights.
No, that's a big mistake actually. Don't think that way. It's not the value of share price after right issue. It's the value of share price after right issue theoretically only. That's why theoretically, as I told earlier, it's only a theory. Theories cannot be true always, cannot come true always. It's only a theory. Theoretically, this should be the share price. But as per market condition, share price can vary. Okay, so always tell the word theoretically. So TERP is the theoretical share price after right issue. Okay. Then you must learn about venture capital. Venture capital is nothing but large companies or large venture capital companies will invest in small growing and highly growth potential companies. That is what venture capital is. Tata do have venture capital, Reliance do have venture capital firms, and many companies do have venture capital firms. So you must be able to understand what is venture capital.
The venture capital acquire below 50%, shareholding.
Venture capital requires below 50%. No, you are not learning any percentage in FM. Okay. You're not learning any kind of percentage in venture capital in FM, financial management paper. Okay. Anyway, SMEs are there, venture capital firms you have to learn. Let me ask you one more question. What do you mean by normal debt versus convertible debt? It's a theory question.
Convertible debt is nothing but afterwards we can convert into shareholding.
Okay, so what are the advantages of convertible debt? Could you please tell me what are the...
No payment of redemption value.
No payment of, instead of redemption value, you can give shares. Okay.
Yes.
But I want much more precise answers. Whatever you told me was right. I'm expecting much more precise answer. What are the advantages of convertible debt over normal debt? So convertible debts do have lower service cost. Service cost means we need to give only lower interest, right? For our company, why we are paying lower interest for convertible debts?
Because we are getting an advantage in future shareholdings can we get?
No, we are not getting. We are the
We will.
company. We are the financial manager. The investor is getting an advantage that he can convert into shares in future. Okay, that's why he will expect only lower returns. So we have to give only lower returns. So do have less service cost. And convertible debts do have higher marketability because of the conversion option. Convertible debt will have higher marketability because of the what you do have an option to convert. And convertible debt will feel more attractive. Convertible loan note will be like more attractive to the investors. So it is good for startup companies. If a startup company is issuing loan note, then they can go for convertible debt because after a few years their shares will go up, right? The investor will be knowing that this share price will be going up in future, and investor will invest in such loan notes. So these are good for startups. So the whole thing I discussed was the advantage of convertible debt over normal debt. It's a frequent question nowadays. Frequent theory question nowadays. Normal debt versus convertible debt. Then you have to learn about Islamic finance. So what do you mean by the term Islamic finance?
Islamic finance,
Based on Muslim Sharia and Quran.
Islamic finance is a finance based on Muslim Sharia law and also what based on Quran. Okay, so Islamic finance is
motive is to not earn interest.
Yeah, not the motive actually. It's not the motive. Okay, in Islam, in the religion Islam, it's actually interest is prohibited. What do you call interest in Arabic?
Riba.
Riba. Interest is called riba. Riba is actually prohibited in Islam. So we have to consider that interest has to be prohibited if you are going for Islamic finance. Okay. So let me ask you, what is the difference between normal finance and Islamic finance? What are the difference?
In Islamic finance, there is no concept of interest earning.
Interest is prohibited. Prohibited in essence, it is called dash in Islam. It is called in Arabic haram. Haram is the word for prohibited. Okay. Then one thing you told me.
Profit sharing is more encouraged in Islamic financing.
Profit sharing is more encouraged. Okay, we have to share the profit. Then
Based on Muslim Sharia law.
It's based on Muslim Sharia law and Quran. Okay, and Quran. Then anything? Can we invest in prohibited activities like alcohol in Islamic finance? If you are going for Islamic finance, can we invest in prohibited activities like alcohol, prostitution, or something?
No, gambling.
No, we gambling. No, we cannot invest in all the stuffs, right? There should be risk. There should be risk. If there is no risk and you are getting returns, then it has to be interest. So we have to take risk in Islamic finance. So the whole thing differentiate Islamic finance from normal finance. Okay. Then there are 5 contracts you must be able to understand. 5 contracts of Islamic finance. Which are the 5 contracts? Yeah. The 5 contracts are Mudaraba, Musharaka, Ijara, Sukuk, and Murabaha. So there are 5 contracts. You must able to differentiate the whole thing. Okay. I'm not telling that you must learn. You must understand the difference between the all the 5 Islamic finance contracts. Okay. So what are the alternative methods we can use for a company in terms of Islamic finance? Okay. So that's you have to learn. What are the alternative methods according to Islamic finance? Anyway, you must be able to, I'm not going to teach you the 5 methods. I can tell you there are 5 methods. Mudaraba, Musharaka, Ijara, Sukuk, and Murabaha. The whole 5 things you have to learn. Okay. Anyway, next chapter would be capital structure theories. Here, in this chapter, you are learning how much.
Can you say that? Sir, can you say about that? All 5 are there, no, sir? Instead of what all purpose are there for Sukuk, Ijara, Mudaraba?
Yeah, I can give you a partial description of everything. Okay, Mudaraba, it's a kind of equity finance. Okay, there are people who are coming in and investing, and there are people who are coming in and managing. Like there are shareholders and managers in a company, right? Similarly, Mudaraba is also there will be investors and there will be managers. Okay, investors do have a name and managers do have a name. Investors are called what? Rabal Mal. In Mudaraba, investors are called Rabal Mal, and those who are managing are called Mudarib. Okay, Musharaka is something different. It's like partnership. Everyone comes in, everyone are part of the management, and everyone are taking the returns. That is called Musharik, right? Musharaka or Musharaka we can call. Okay, then Musharaka will be there. Next one. Murabaha, yeah. Murabaha. I can give you another thing. Sukuk. Sukuk is like a loan note. In Islamic finance, we cannot issue loan note and collect interest, right? Instead of that, we will issue loan note, and without giving interest, we will give an ownership of an asset. Whatever the profit that asset is making, the one who bought that loan note, the Sukuk, will be able to get the returns. Okay, will be able to get the returns from the profit generated by that asset only. Okay, that is what Sukuk is. Then Ijara. Ijara is a kind of leasing. It's a kind of leasing. And finally, Murabaha is there. Murabaha is like taking the loan. Okay, Murabaha is like taking a loan. I'm not going to discuss the whole thing. It's we do have what limited time only. I can tell you this is what that. Okay.
Yes.
On our proper session, if you would have asked the same thing, we do have more time. So I would have told everything. Okay. Now I cannot tell everything because if we are in a hurry. We should go and see. We should learn everything in a shorter perspective. Okay. That's why I'm not going to tell the whole thing. I can tell you these are the things you must be studying. I'm not going to teach you, but I'm telling how to learn. Okay. I'm not teaching you. I'm telling how to learn. Okay. Anyway, capital structure theories are there. So it's nothing but what is the capital structure? Capital structure means how much percentage of equity, how much percentage debt should there be in a company. Based on that, there are some theories. Could you please name some theories? Capital structure theories.
Traditional theory.
Traditional theory. First of all, they introduced a theory called traditional theory. Then after that, two scientists came, and then they introduced one more theory, and their name is M&M theory. What is the full form of M&M theory?
Modigliani and Miller.
Miller theory.
Modigliani and Miller theory.
1958.
1958. Oh, very good, Yusuf. You are more accurate than everyone. It came in 1958. Later, after a few years, M&M theory without tax first introduced. Then after a few years, they introduced the impact of tax. Modigliani and Miller theory with tax. Okay. First of all, they didn't find the impact of tax. Then they took tax. If tax is there, what will happen? Okay. That is what Modigliani and Miller theory with tax. Then
Pecking order theory.
Pecking order theory is that. Practically, most companies are following pecking order theory. So it's one of the most tested question among these theories, pecking order theory. So let me ask you, in pecking order theory, where shall we find the capital first? First
Return
rank
earnings.
return earnings. First we will take from our own profit, which is called return earnings. Then second,
Debt.
debt because we do have tax benefit on debt. Then third,
Equity.
Okay. So that is the order in pecking order theory. Anyway,
Debt.
yeah, debt first, return earnings, then debt, then equity. You have to learn the reason also. Why return earnings comes first, why debt comes in second, and why equity is coming in third position.
Because of reason of risk, I guess.
Yeah, reason of risk. There are more reasons. You must be able to learn that in pecking order theory. Anyway, then you have to learn why. What are the problems of high level of gearing? What are the problems of high level of gearing? Problems of high level of gearing. What are the problems of high level of gearing?
Bankruptcy risk.
Bankruptcy risk. Tax
Agency
extortion will
cost.
be there. Agency cost can be there. Then
Impact of borrowing.
yeah, it will affect our borrowing capacity. Then
Increase WACC.
it will increase the WACC. Since more gearing, the investors will need more returns. That will increase the WACC. Then
Restriction in article of associations.
in article of association, there can be restrictions. So all the thing you have told, everything you have told are perfect answers for a question. Okay, question of problems of high level of gearing. Okay, so that is what you are learning in capital structure theories. Anyway, on next chapter, you must be able to learn 3 theories only. Dividend policy. It's a small chapter, very small chapter. Within half an hour, you can learn the whole theory, the whole chapter. There are dividend irrelevancy theory, which state that dividend is irrelevant. Even if you didn't give dividend, it's not a problem. That is called dividend irrelevancy theory. Then residual theory is there. And finally, dividend relevancy theory is there. Dividend should be relevant. This is the most important theory in dividend policy. Dividend is, I'm marking it in red color because it's one of the most important question. Dividend, a proper dividend is relevant. A proper dividend policy is relevant in a company because of 3 things. Which are the 3 things? 3 points you can give. You can tell signaling effect, liquidity preference, and clientele effect. Clientele effect. These are the 3 effects in which it states that a proper dividend policy is necessary. Okay, that is what dividend relevancy policy is. And then finally, we do have financial ratios. There are number of ratios, but I can give you some important ratios. Which are, I will be writing here few important ratios. Don't consider this is the most this is the whole thing, but these are the important ratios. I can tell you what operating profit margin. Okay, it's an important ratio. Then operating profit margin. Then EPS, earnings per share. Then you have to learn about PE ratio. Then you have to learn about earnings yield. Then dividend cover ratio. So what is the connection between PE ratio and earnings yield?
EPS opposite, PY is opposite is EY.
Yeah, PE ratio is the opposite of earnings yield. So dividend cover, interest cover, dividend yield ratio, and finally I would say this one also, dividend yield and interest yield. Interest yield ratio. Then EPS, P ratio, earnings yield, dividend cover, interest cover, dividend yield, interest yield.
TSR.
Yeah, TSR we have already told. Gearing ratios. Gearing ratios. Sorry, not gearing ratios. Financial gearing and operational gearing. And also gearing ratios and liquidity ratio. Current ratio, quick ratio. Okay. So the whole ratios you have to learn. Okay, these are the important ratios. There are n number of ratios, but these are the most important ratios you should be able to understand.
So these
Okay.
liquidity ratios are in working capital.
Yeah, liquidity ratios are in working capital, like current ratio and quick ratio. Okay. From the whole thing, I can tell you only 3 type of question can be tested in session C. In section C, you can expect only 3 types of questions, and the 3 types of questions are one question can be WACC, calculation of weighted average cost of capital. One question can be of equity or debt, whether we should raise finance through equity, or what will happen to our current EPS if we go for equity. So equity means right issue. What will happen to our current EPS if we go for loan note, which means debt? Anyway, equity versus debt is a important question. And one more question you can expect, that is project specific K. Project specific K. Okay, these are the 5 important questions that you can expect from business finance. Okay, so these are the 5 important questions that you can expect from, sorry, 3 important questions. 3 important questions that you can expect from business finance, right? Okay, so for WACC calculation, I can give you 5 questions. For WACC calculation, I can give you 5 questions, 5 important questions. You must be able to do all the 5 questions. Practice. Okay, you can go for Corfe company. It's a WACC calculation question. Corfe company, AMH company. It's a WACC calculation question. Okay, you can go for Fence company. Again, it's a WACC calculation. Then Marble company, and finally Tufa company. Okay, you can practice the whole 5 questions. All the 5 questions are WACC calculation. Now let's go for equity versus debt. Again, I can give you 5 questions here. Okay, equity versus debt. Spine company, then Laforge company, then Tin company, then Gamgee company, then Grafam company. Okay, all the 5 questions are questions of equity versus debt. Equity versus debt. Okay, the whole 5 questions are equity versus debt question. And finally, project specific A, there are only 2 questions available for you. One should be Zedamore company, and one should be card company. Okay, in our normal class, we do solve the whole questions. Okay, we do solve the whole questions. Okay, all questions will be solved in our normal class. Now we are not in a position to solve all this. I can tell you, but I can tell you these are the important questions, right? Okay, if you are able to understand how to answer these questions, I can assure you full marks. I can assure you full marks in calculation. Theory question will be based upon the topics I have already discussed, right?
Sir, these all questions are enough, sir, for preparation.
Yeah,
Because
this is more.
25 days is there.
Yeah, more than enough. It's 12 questions are there from a single topic. Okay, from a single topic called business finance, I have given you 12 questions. If you are able to do yourself all these questions, you will crack full marks in calculation. I can assure you. This is the entire thing that I can ask. Nothing more. Nothing more you can expect from what business finance. This is the entire thing. The whole thing is what incorporated into these 12 questions. Okay, I mean the calculation thing, right? So you can expect. I'm not going to tell you which are the theory question. The theory question will be from here. Okay, anywhere from here. It can be from Islamic finance. It can be of what normal debt versus convertible debt. It can be problems of high level of gearing. It can be equity fundraising method. It can be systematic risk versus unsystematic risk. It can be the assumptions made on CAPM model. It can be pecking order theory. Anything. I have already mentioned many theory questions here. Those are the important questions you can expect. Okay, so that is from business finance. Now, okay, let me teach you TSR now. TSR. Okay, what do you mean by the term TSR?
Total shareholder return.
Total shareholders return. TSR do have an equation. Okay, you have already told me that. What are the 2 types of returns that a shareholder will expect?
Capital gains and dividends.
Capital gains. Capital gain means the increment in share price, right? So the increment in share price will be like closing share price minus opening share price, right? This is the increment in share price. This year closing share price minus this year opening share price. That is the increment in share price plus dividend. What is the dividend that you get this year? okay, plus dividend divided by opening share price. Opening share price into 100. Okay, you will get TSR, right? This is the equation. So let me check who can answer first. I will give you a question. Here. Let me check who can get the TSR first. Okay. Opening balance this year was opening balance, and I will give the closing balance, and I will also give the dividend that is paid this year. Okay. Opening balance is 100. Opening share price is $100. Closing share price is $120, and dividend paid is $5. So what is the TSR? Let me check who can answer first.
25%, sir.
How much?
25.
25. So the closing share price is 120 and opening share price is 100. So the difference, the capital gain is $20, right? Closing minus opening, $20 plus dividend paid is $5, right? So it is 20 plus 5, 25 divided by opening share price, which is $100. So 20 plus 5, 25 divided by $100, it's 25%. So the TSR is 25%, right?
Sure, yes.
Yes, the total returns that the shareholders will get this year is 25%, right? Okay, then let me ask you about TERP. Let's see who can answer first. TERP. Okay, if a company current share price is $10, okay, current share price is $10, they are giving a right issue in the ratio 1:4. In the ratio 1:4, and they are giving the shares for a 20% discount. So what is the TERP? Current share price is $10. They are giving 1:4 right issue, and they are providing a 20% discount in right issue. So what should be the TERP?
9.6.
9.6. 9.6 is the TERP. Okay. So how to calculate TERP? TERP can be calculated by the equation. Okay. Currently, the 1:4 is the right issue, right? So currently there are 4 shares. Each share is will cost $10. So 4 into 10. This is the current what equity shares they have. So additionally, if they are raising one more shares for 20% discount, which means the new share will give only $8. So additionally, they will raise 1 into 8, $8 divided by totally how much shares will be there after right issue. So after right issue, currently there are 4 shares plus after right issue, one more share could come. So divided by 5. So 4 into 10, 40, 40 plus 8, 48, 48 divided by 5 will give you 9.6. Okay, that is what TERP. So here I'm asking you, what will be the value of right? What will be the value of right?
0.4.
Value of
8.
right could be, no, it's not 8.
0.4.
Value of right.
Value of right. Okay, let me teach
Share
you.
price minus TERP.
Okay,
1.6.
let me teach you.
0.4.
First of all, market value. Then we got TERP. Then we do have right issue price. Okay, right issue price. So let me ask you, what was the market value of shares? First,
10.
before right issue, $10. Okay. So what was the right issue share price? $8.
8.
What was the TERP?
2.
9.6.
TERP was
9.6.
9.6.
9.6, right? So the difference between TERP and value of right. The difference between TERP and value of right. This is called the difference between TERP and right issue share price. This is called value of right, which will be 9.6 minus 8, which will be
1.6.
It's 1.6.
1.6. So value of right will be 1.6. So I can give you value of right will be 1.6. And what will be value of right per existing share?
0.4.
0.4 actually. Okay.
0.4.
It's the difference between market value and TERP. This is value of right per existing share. Per
0.4.
existing share, which will be 10 minus 9.6, which will be
0.4.
0.4. So value of right per existing share will be
0.4.
0.4. $0.4. Value of right will be 1.6. Okay, you can also calculate value of right per existing share by another equation called, you have already got value of right, right?
Yes.
Value of right, you know, which is 1.6. You can simply divide it by number of existing shares, which is 4. 1.6 by 4, you will get value of right per
100.
existing share, which is also 0.4. Okay, both equation you can use, right? Both equation you can use. Am I right?
Yes, sir.
Okay, that is what value of right and what? That is what? Value of right and Turpan, value of right per existing share, everything. Okay. Okay. Then let me ask you. So I have already discussed about Islamic finance, right? There are 5 Islamic finance methods, 5 Islamic finance contract. Which are the 5 Islamic finance contracts?
Mudaraba, Musharaka, Murabaha, Sukuk, Ijara.
Yeah, there are 5 Islamic finance contract. You must be able to understand. And the 5 things are, first of all, I would say Mudaraba, then Musharaka. Those who don't know, please take the notes. Sukuk, then Ijara, and finally Murabaha. Okay, Murabaha. Okay, Mudaraba is much more like a right issue or raising equity finance. This is much more like equity finance. Okay, Musharaka is like a partnership. It's like a partnership. Okay, and Sukuk is simply but loan notes. Loan notes. Ijara is a kind of leasing. Ijara is a kind of leasing. And Muraba is like a loan, or like it will be like credit sale. Credit sale, or else you can say loan. Okay, so these are the 5 Islamic finance contract. You must be able to write for 3 marks. At least learn for 3 marks everything. You must be able to write about Mudaraba for 3 marks, about Musharaka for 3 marks, Sukuk for 3 marks, Ijara and Murabaha for 3 marks. Everything you have to learn for at least 3 marks, right? Are you getting the idea? Kindly tell me whether you are getting the idea or not.
Yes, sir.